Hey everyone, let's jump right into this. Welcome to today's Explainer, where we're unpacking a really fascinating comprehensive technical report from the Economic Analysis Observatory. The research date for this data is May 13, 2026, and wow, let me tell you, the crypto landscape has evolved so dramatically over the last few years. Today, we're going to break down the history, the underlying tech, the latest market metrics, and of course, the very real risks baked into this ecosystem. We are stripping away all the hype to give you a purely objective, educational look at how this world actually operates.
First up, let's map out exactly where the landscape stands in May 2026.
Before we can even start talking about how the engines work, we really need to appreciate the massive scale of this market today. Just wrap your head around this number, 2.68 trillion US dollars. That is the total market capitalization of the entire crypto asset space as of our May 13, 2026 research date. It's honestly staggering, and it highlights the sheer financial gravity of the sector right now. Whether you're a traditional investor or just a tech enthusiast, a number that large means this market literally cannot be ignored anymore.
But, even though we're talking about a multi-trillion-dollar space, the wealth is incredibly top-heavy. It's not evenly distributed at all. Bitcoin still completely dominates, commanding over 60% of the entire ecosystem's value. Ethereum comes in a distant second at nearly 10%, and then those thousands of other alternative coins, the altcoins, they just make up the remaining 30% or so.
Okay, moving right along to Section 2, the technology fundamentals under the hood.
Shifting gears from market size to actual mechanics, these networks basically achieve consensus in two very different ways. On one side, you have Bitcoin's proof of work. In this system, miners use massive amounts of computational power to solve complex math puzzles and secure the network. It's highly secure, but man, is it energy intensive. Then, on the flip side, we have Ethereum. They actually transitioned to a proof-of-stake model back in 2022. So instead of burning all that electricity, validators lock up or stake their own tokens to secure the network. That one move drastically reduced Ethereum's energy consumption by over 99%. It was a real game changer.
But we absolutely need to talk about Section 3, the dark side and the risks.
Because it is crucial to understand that the explosive growth in this space, it's been accompanied by some truly devastating systemic failures. The history here is pretty wild. Going all the way back to 2014, the Mt. Gox bankruptcy wiped out hundreds of thousands of Bitcoins. Fast forward to the brutal year of 2022, and it gets even worse. In May, the algorithmic stablecoin Terra/Luna completely collapsed, erasing an estimated $40 to $45 billion in literally 72 hours. Then, just a few months later in November, the FTX exchange went down under the weight of an $8 billion fraud. The fallout there was massive, and it actually led to decades-long prison sentences for the founders.
And those historical blowups point to very specific, heavily documented risk scenarios that are just inherent to this space. You've got algorithmic stablecoin death spirals, where the math keeping the coin pegged to a dollar just breaks down. You have smart contract vulnerabilities, meaning a tiny bug in the code can lead to millions being hacked, and there's no customer service line to call to reverse it. There's also the irreversible loss of private custody keys, meaning if you lose your password, your assets are gone, forever. And finally, centralized counterparty insolvency, which is really just a fancy way of saying the exchange holding your crypto goes bankrupt and loses all your funds.
Now, concrete dangers like that, they fuel some very sharp criticisms. For instance, the prominent economist Nouriel Roubini has bluntly called this whole space the mother of all scams. A lot of critics from traditional finance and academia point out that market manipulation, a total lack of intrinsic value, and severe environmental impacts are fatal flaws for the industry.
But on the exact opposite side, there is a very fierce institutional counterargument. Take Fidelity Digital Assets, for example. They actually describe Bitcoin as a potential store of value in digital gold. Their whole thesis is that because Bitcoin has a strictly capped supply of 21 million coins, it functions as an inflation-resistant asset. To them, it offers unique diversification for modern investment portfolios.
Which leads us perfectly into Section 4, institutional adoption and market mechanisms.
Traditional Wall Street has forcefully entered the chat here. And one of the biggest mechanisms these institutions are obsessed with is the Bitcoin halving. So what is it? It's basically a programmed event, hard-coded into Bitcoin, that happens roughly every 4 years, or every 210,000 blocks, to be exact. It literally cuts the daily supply of new coins created by miners right in half. The most recent halving just happened on April 20, 2024. Institutions heavily factor this deflationary mechanism into their long-term supply and demand strategies.
Next up, Section 5, the new regulatory framework.
Because when institutional money shows up, institutional rules follow right behind it. After the chaotic collapses of 2022, global authorities have been working overtime to build serious guardrails, but it's playing out very differently depending on where you look. In the US, it's kind of a fragmented framework driven mostly by SEC and CFTC enforcement actions, though they did finally approve spot ETFs in early 2024. Meanwhile, the European Union took a much more unified path with their MiCA regulation. They're mandating strict licensing and explicitly banning those unbacked algorithmic stablecoins that caused the 2022 crashes. And down in Brazil, we're seeing a highly structured approach with Law 1447-8 and central bank rules taking full effect in 2026, which demands comprehensive licensing and a very strict segregation of client assets.
All right, let's wrap this up with Section 6, Strategic Insights, and our conclusion.
Synthesizing all of this May 2026 data, a few really clear strategic realities emerge. Number one, institutional capital is absolutely here. Spot ETFs surpass $200 billion in assets under management, which is locking up a vast amount of the available supply. Number two, despite all that digital gold talk, crypto still shows a remarkably high correlation with traditional equities whenever the broader market is under stress. Number three, that 2024 halving fundamentally restricted new coin issuance. And lastly, the Wild West days, they are fading fast. Stringent global regulations are heavily penalizing bad actors and effectively forcing the market to grow up.
Which leaves us with this final, genuinely provocative question to think about. As traditional finance and global regulators wrap their arms tighter and tighter around this space, will these institutional guardrails finally stabilize what has always been a notoriously volatile ecosystem? Or are the underlying technological and operational risks simply too baked in to ever fully mitigate? It is an absolutely fascinating macroeconomic shift, and we'll definitely be keeping our eyes on it.
So if you found this explainer valuable and you want to keep making sense of these massive global shifts, make sure you hit subscribe on the Macroeconomic IA channel. We are constantly covering the absolute latest insights across macroeconomics, artificial intelligence, and technology. Be sure to click the links in the description to follow us, and definitely stay tuned for our upcoming deep dives.
And just a quick final note before we go. Please remember that this explainer is strictly for educational and informational purposes, utilizing open third-party data referenced as of May 13, 2026. It does not present any ideological bias, and it absolutely does not constitute financial or investment advice of any kind. These markets are highly volatile, and past performance is never a guarantee of future results. Thanks so much for learning with us today.